Dear students, this video is going to look at exchange rate risks. That's the risks that you take when you buy something somewhere else, and the fluctuation of interest rates will actually maybe make or break your deal, and how you can avoid that type of risk. One of the biggest challenges when it comes to international business is accounting. Multinational corporation has to pay attention to all the rules around the world when it comes to accounting. It wouldn't be so bad if all the currencies were the same. The problem is that everyone uses different currencies and they fluctuate. So how do you keep track of your inventory, the value of your inventory in all these different countries when the currencies prices are fluctuating left and right? Internally, that inventory might have one price, but the value of that inventory price in a different currency might totally change. Sometimes it's high, sometimes it's low. To simplify things, Financial Accounting Standards Board, or FASB, or International Accounting Standards Board, ISAB, works on making it easier for businesses to do business across border lines. The Financial Accounting Standards Board is a authoritative board in the United States that specifies accounting policy for U.S. businesses and certifies public accountants. It's a self-governed organization. Here's some history on how things happened. FASB 8 became effective in 1976. Its objective was to measure in dollars on enterprise assets, liabilities, revenues, and expenses that are denominated in a foreign currency according to the General Accepted Accounting Principles, GAAP. Historically, exchange rates was used, and if it did not reflect the current value. So the current value is very important. However, in 1979 to 1982, the International Accounting Standards Board decided to look for a simpler way to set value of inventory. As a result, FASB 52 was issued. Functional currency is defined as a currency of the primary economic environment in which the entity operates. In other words, the spot rate is easier to use than historical prices. As of 2005, all companies doing business in the European Union has to use accounting standards set by the International Accounting Standards Board. That makes it easy for businesses in the United States and the European Union to do business in each other's nation states. We'll take a quick look at 4 different types of methods to recognize different types of transactions. One is current, non-current method, monetary, non-monetary method, temporal method, and the current rate method. And we'll see the results of that. First, let's look at the current, non-current method. The underlying principle is that assets and liabilities should be translated based on their maturity. Current assets translated at the spot rate. That's right now. Current assets translated at the historical rate in effect when the item was first recorded in the books. Monetary, non-monetary method. The underlying principle is that the monetary accounts have a similarity because their value represents a sum of money whose value changes as exchange rates fluctuate. All monetary balances, such as the different types of accounts, cash, marketable securities, accounts receivable, and so on, of a foreign subsidiary, are translated at the current exchange rate, sometimes on a daily basis. All other non-monetary balances, such as owner's equity and land, are translated at the historical exchange rate in effect when the account was first recorded. The temporal method. The underlying principle is that the assets and liabilities should be translated based on how they are carried on the firm's books. Balance sheet accounts are translated at the current spot rate, exchange rate, if they are carried on the books at their current value. Items that are carried on the books at a historical cost are translated at the historical exchange rates. In effect, at the time the firm placed the item on the books. The current rate method. all balance sheet items except for stockholders' equity, so shareholders' equity, are translated at the current exchange rate. Very simple method to apply. A plug, or it's really an equity plug, that the accounts named cumulative transactions adjustments is used to make the balance sheet balance. Now let's do a side-by-side comparison and see how the numbers change. Here we have the local currency. That part is straightforward and simple. Now here are the different types of ways you can conduct your accounting. So follow along here as I switch images. Here you have the book value of the inventory, how it's changed. You see the different historical rates right here, but here you have it adjusted for the spot rate. In this case, you have the spot rate below on total assets. The historical rate, here we have where it's following the spot rate. They all use the historical rate for retained earnings, and they get it from the income statement. Now this is where it gets a little interesting. Here's where you add the little plug to make an adjustment to make the balance sheet balance. In the following examples, we're going to look at what happens with sales as the average exchange rate over a period of time equals to €2.50 for $1. You have the exchange rate right here, except for here where €2 equals to $1. Here you have €3 equal to $1, and here we have 250 equals euros equals $1. Note the effect after the tax profit. One main reason why we have accounting standards is to make sure that everyone understands how accounting is done, so that we can compare apples to apples instead of trying to compare an entire basket of different fruits. It protects investors from creative accounting that so often hurts investors, shareholders, employees, and stakeholders. I hope you liked this video, and if you did, give me and follow my page. I also suggest that you take a look at my playlist that has awesome, fantastic videos on stuff that you want to watch. Okay, lots of good econ stuff. People like Ray Dalio, Milton Friedman, Carl Icahn, Shark Tank, and other episodes that I think you're gonna totally enjoy and help you better understand the economic world that we live in. So, see you soon. Take care. Bye-bye.